Hi everyone, welcome back to the Moneyweb Better Investor Conference. My name is Fifi Peters and I am excited to be joining the conference for the very first time this year. So my session is on investing offshore for returns and residency benefits. And I'm sure many of you will be aware that there has been recent changes in our regulation that does allow you to take a whole lot more money outside the country right now for investment purposes. And it's a great thing, really, except a number of places in the world right now are looking pretty scary. If we start off with what has happened in Europe so far this year, where stock markets over there are lower because of the Russia-Ukraine war that continues to ravage on with no end in sight at this present moment in time. If we skirt over to another continent, over in Asia, where that part of the world has given quite a number of investors a lot of sleepless nights and probably a few extra gray hairs. If we take a look and we take stock at that stock market right now, the Hang Seng Index most notably down 25% so far since January. And then going over to the US, where that economy is popping right now, everything is looking pretty sweet, except the stock market, which also has pulled back quite a bit, with the technology-heavy NASDAQ index by far the biggest loser on that front, down 30% since the start of the year as a result of inflation that is looking a lot more sticky than was initially expected, and the implications for interest rates that could rise more aggressively, just give and take. And so you look at what is happening in the rest of the world and you contrast it with what is happening here in South Africa, where we have had record load shedding in this country, where our inflation has also been pretty rampant, where our interest rates have risen faster than most of us would have liked, and also where our economy has mostly underwhelmed. Despite all of this, the South African stock market hasn't done so badly. In fact, outperforming quite a number of its global peers. And so it's against this context that we're asking, can offshore investments right now give you a lot more bang for your buck? Or, like Dorothy said in The Wizard of Oz, is there no place like home right now? So I'm posing this question to David Lerche. He is the head of equities at Sanlam Private Wealth and also soon to be a chief investment officer over there as of January. David, good afternoon and thanks so much for joining the conference.
Afternoon, Fifi. Thank you for having me.
So let's start off then with what we should be doing right now with our money, just given the fact that the grass is looking pretty green here in Mzansi, in South Africa, our land, from a stock market perspective. Why then should we be thinking about taking money elsewhere? Just give us the bigger picture.
Right. Fifi, so there's multiple things to think about here. Firstly, when you're investing, you've got to try and think quite long term. So, don't just worry about what's happening today. It's about much more the long-term situation, how things are playing out over an extended period of time, because one doesn't just invest for a year, you invest for many years. But right now, markets probably looking a lot more attractive than they did this time last year. This time last year, we said, international markets were looking very expensive. We didn't expect them to be down 20% this year, but certainly we thought they were very expensive this time last year. So we've had relatively little money offshore and relatively more in South Africa. But I think the key point there is it's a relative thing. You always want to have some of your money offshore, and you always want some of your money in South Africa if you're a South African-based investor. And really, it's just a case of how much you have in which geography at which time. And I can show you some pictures if you'd like to help that thought process.
Yeah, and especially in this current environment where the outside world has been looking slightly less appealing than here at home. But as you said, it's not just about what has happened in the past year, what has happened in the past 3 years. It's about the bigger picture. So just give us that bird's eye view of the performance of South African equities versus our global peers.
Right. So hopefully this is up on everybody's screens right now. This is a 50-odd year chart. I think it's 51 years of data we have here of the South African market, which is the black line relative to global equity index, being MSCI World Index. That's the blue line. So if you'd started with just 100 Rand all the way back in 1971, now, and you'd just kept all your money and all your dividends in the markets in South Africa, now you'd have near enough to 400,000 Rand after 50 years. If you'd kept it in global equity markets, in Rand terms, you'd now have about 200,000 Rand. So over that very extended period of time, it's certainly been better to have had your money invested in South Africa. What the chart only shows a little bit just because of how the scales work. I'll show you a better scale a bit later. But what it doesn't show you is that the ride as a South African investor has been a little bit more bumpy. It's been a little bit more volatile in our market relative to global markets, even in Rand terms. But you have been rewarded for taking that risk by investing in an emerging market like South Africa, rather than investing in global equities, which is predominantly sort of around about 70% of global equities are actually American businesses. But yeah, the statistics, certainly looking backwards, say that it was better to have been in South African equities. And I'll maybe show you a picture a little bit later where I show you that if you get the blend correct of having both South African equities and global equities in your portfolio in roughly the right ratio, you can actually outperform either of these lines when looking backwards, and at the same time get a little bit less volatility, so a smoother ride along the way.
So just if we drill into the equity space and which parts of the markets have done pretty well and have given investors these kind of returns over this time period, where has the action been in the local equity market, as well as if you can just paint a picture of which part of the global equity market has been the safest place and more lucrative place to make returns in the recent while?
So I think firstly, the safest place is often a very dangerous thing to think about when you're thinking in terms of equity markets and stocks. Often things that look the very safest have not delivered the kind of great returns you would hope. You look back a year ago, roughly, everybody was saying things like Facebook and Amazon, fantastic businesses, wonderfully safe places to keep your money, except Facebook is down 70% so far this year, and Amazon's down quite a lot as well. So, if you do, however, look over, say, the last 10 years, certainly US tech has been the place to be, call it since the financial crisis. That's been the better place to be. And post-COVID, for sort of 2020 and 2021, US tech, fantastic. 2022, terrible place to be US tech. You'd much rather have been in something like energy, and also a pile of really boring stocks. Tobacco, for example, which everybody knows is bad for you. Tobacco stocks have actually outperformed quite substantially this year. But really, I suppose the recent action has been in energy, and then obviously, you could have made some good money in defense stocks, something like General Dynamics. I think I saw this morning up around about 30 or 40% year to date. They make, amongst other things, tanks and some aeroplanes. So, multiple different places. But I think rather than thinking about sectors that have done well over any specific time frame, you should rather think about making sure a portfolio is appropriately balanced, because it's very, very difficult, and nobody has shown themselves to be able to achieve it consistently. It's very difficult to know exactly what's going to be the perfect place to be. And the world, of course, changes all the time. I don't think many of us this time last year were banking on a war in Europe for most of 2022.
Yeah, I think very few people, in fact. But David, take us through to your next slide, and also perhaps comment on what a appropriately balanced portfolio looks like in this environment?
Right. So maybe let me take you through a couple of pictures here. I'll get to the second part soon enough. But this chart really just shows you South African equities relative to global equities. So I just based it at 1 back in 1971. And essentially, when the line is trending upwards, that's when South Africa has done better. When the line's trending downwards, that's when global equities have done better. And really what you can see sort of in post-democracy South Africa, what I've highlighted here with the red lines, is there have been sort of 2 periods where South Africa has underperformed and 2 periods where we've quite nicely outperformed relative to global peers. Obviously, the big one there from sort of round about 2000 to round about 2010, that's really when the resources space did particularly well. South Africa, of course, quite a resource-intensive country. And the other side to remember is that in 1999 and 2000, global markets were exceptionally expensive. So, that's the time when you had things like Coca-Cola trading at 60 times its earnings. When it was at the time of the dot-com boom when, you had crazy things listing like pets.com on no information and no business plan. It feels a little bit like crypto in the last 6 to 12 months. And so from that very high point where global markets were doing exceptionally well, then the pendulum swung towards resources. We saw the rise of China importing a lot of commodities from the rest of the world. That obviously did very well for South Africa until a little bit after global financial crisis. And then sort of in the post-GFC period until COVID, you've really seen the rise of internet stocks doing particularly well, but actually having real cash flows to back them up. And in general, in that very low interest rate environment, the market loved quality. So a sort of a high quality philosophy did particularly well from, call it 2010 to 2020. We're starting to see a little bit of an uptick now, just the last 18 months to 2 years from South Africa on a relative basis. Time will tell whether that has legs or not. But do remember that a large proportion of our local market anyway makes its money offshore. Our largest resource companies have mines all over the world. Obviously, 2 of the other largest stocks on our market, Richemont and Naspers or Prosus, their business, a lot of that is in China. So, don't think of our local market as purely about the South African economy. And then maybe I'll skip this slide and maybe we can come back there and we can come back to some of those other pictures. But to answer your second question around what a good portfolio looks like, it's really about blending all the different pieces. Remember, one of the key tenets of investing is that you want to get the highest return for the lowest risk. And typically, if you want higher return, you're going to have to stomach a little bit more risk. But what happens is if you manage to effectively blend the different components of your portfolios, and here on this slide I show components of what I'd call a global multi-asset portfolio. And what we're showing here is the correlation of returns between different asset classes. So a correlation of 1 is a perfect correlation, and that's the only things will correlate at 1 to themselves. But if you look at the first column there, it shows you how different assets correlate to MSCI World Index, which is global equities essentially. And what you want are the other building blocks within your portfolio to be quite uncorrelated and, if possible, even negatively correlated to the main equity building block, because that will typically, for long-term investors, your largest component of a balanced portfolio will be in equities. And then the other pieces, you want to make sure that they are less correlated. So, for example, I've highlighted two blocks there, that red block where I highlight multi-strategy fund B. I on purpose leave everybody's names out here. But that multi-strategy fund, which is supposed to be a less correlated asset to global equities, actually the statistics tell you it is quite correlated. By contrast, the one above it, the multi-strategy fund A, that's the one we use when building our client portfolios. That one has a slightly negative, but basically uncorrelated set of returns to global equities. And you want to populate your portfolio with pieces like that. You would also look within the bond space, this bond fund B, lower down, that's the one you want. You don't want, for example, a credit fund, because then you're kind of just exposed to the same set of risks and drivers as the equity component of your portfolio. So a credit fund, by that I mean corporate credit or corporate debt. You'd much rather have the defensive portion of your portfolio being the debt or the bonds side of your portfolio. That you'd much rather have in essentially dollar-denominated US government bonds, because that's got the lowest correlation typically to global equities. So that's sort of a little bit of advice on how to piece it together. I can go into more detail if you would like me to.
Yeah, I think I would. Just in terms of... Okay, no, go ahead.
Right. Fifi, maybe this picture can sort of help illustrate a little bit what makes sense in terms of a diversified portfolio. So I showed everyone the two lines earlier of South African equities, which on this chart now is the kind of orange line, and then global equities, which is the black line. And however, if you go back and you test the data, and if you'd simply had a portfolio made up of 65% global equity, 65% South African equities, and 35% global equities, and you rebalanced it to that ratio every 3 months. At the end of each quarter, you rebalanced it to that ratio. Then you get the thicker blue line here. Now, what's important, firstly, is the blue line is less wiggly on the screen, believe it or not. It is less volatile. More importantly, the blue line has given you a higher return than either of the components. So you've kind of won twice here, where firstly, you've gotten more return in total over the 51-year time horizon here. And secondly, you've done it with less volatility. And less volatility is a wonderful thing for individual investors, because it means you're less stressed out about the running of your portfolio, because your returns don't look as dramatic. I'll see if I can illustrate it. Here we go. This slide sort of illustrates it. This is just using some statistics. Don't worry too much about the back end. But essentially, the higher the number here, the higher your volatility. And you want to have lower volatility. And again, you can see the blended portfolio, the standard deviation of returns of 9%, actually got lower volatility than either the South African equities or the global equities. So you've gotten better returns than either of these options, and you've had lower volatility or lower risk than either of the options by blending them. And that's just talking within the equity space, South Africa versus international. But the concept of getting better returns and lower volatility exactly works together with what I was showing you earlier on that sort of multicolored boxes of blending the right kind of assets with each other to get the right outcome. Okay.
So essentially what you're saying is that the right kind of blend between global and local right now can give you a lot more peaceful nights of sleep. But let's dig further into that blend and the science behind your 65% allocation in South African equities and the remaining percentage in offshore markets. How did you come to that exact split? And especially given the fact that recent regulation now allows you to take even more money offshore, why could that potentially not be the right blend?
Right. So we got to the 65-35 by basically looking back at the data, using history as our guide. And if you've got enough data over a number of years, that should be a pretty good guide. And that can sort of inform your base case scenario. So for us, this is just talking in a pure equity portfolio, just the blend between the South African component and the global component. You'd have around about 35% in global equities. But even if you were to take a multi-asset portfolio with bonds and stocks, maybe a little bit of cash, a little bit of a hedge fund possibly in there, and you combine it together, also pops out the data to tell you that around about 35% has been the right number on average. If you got to pick one number and stick with it for multiple years, that's the kind of thing you'd like. What I love about the new regulations is they now allow you to go to 45% offshore, should you so wish. So in the past, we couldn't go more than 30% for pension money. So the problem there is we were kind of always at the limit. So you couldn't move a client's portfolio around appropriately to express your views, because you kind of always wanted at least 30% offshore. Now we have the capability to take more money offshore in pension funds, and we can decide when times are appropriate for that, we'll do so. When they are less appropriate for that, we might have more than 65% in SA. And it's lovely to have the wiggle room from the regulator to be able to do that, because it should, with time, facilitate superior returns for the South African investment industry as a whole. So I'm actually quite excited about that. But if I look at markets right now, as I said, beginning of the year, global markets were very expensive. We were distinctly favoring South Africa. At this point in time, I think our market is still probably looking a little bit more attractive on the equities side than global markets, but not dramatically so. So we're not substantially away from this sort of 65-35 split. I think we sort of maybe 66, 67% South Africa, very small deviation from our kind of default level. But what's quite interesting is global bonds, which at the beginning of the year were yielding you, 1% or something pointless, and in an 8% inflation environment. Now those yields have come up quite a bit. So global bonds are starting to look a little bit more interesting, but then South African bonds are kind of interesting as well. And it's because we've got more interesting bond yields as an option that's part of the reason equity markets haven't done so well this year, because last year there was no alternative. Last year you could just be, there was no point investing in bonds for 0.5% or 1% return from a US government bond. Now you can get a reasonable return there, so you can actually have a better balanced portfolio in a lot of ways. Sorry, a little bit of a mouthful, but hopefully that gave you some context.
Oh, welcomed mouthful, quite a lot of food for thought there. But we've got some questions that are coming through from the audience that are tuned in. But I just have one for you before we do take those questions. Just what do you mean by offshore right now? I mean, you've mentioned in terms of the bond market, your preference for US bonds or US treasuries. But what makes a good offshore investment right now, just given everything that's going on in this world?
Right. I hate to be boring, but it's the same as always. It's paying the right price for the right asset. So that means if you are within the equity space, for example, you want to make sure you are paying the right price and preferably buying businesses that have a lovely long future. So you want to be paying for you want to be paying as the price for a good business and buying a great business. Great businesses can take many forms. Everything from something like Google, which I think is a fantastic business and will stand the test of time. Other things like Johnson & Johnson, I think is a lovely set of global brands. There's some other interesting stuff in the sort of more corporate focused IT space, maybe something like an SAP, quite an interesting business. And there's a lot of interesting stuff in the medical space. But most important is you want to pay the right price. So if you can pay the right price for the asset, then you'll probably do quite nicely. one also has to sort of look through current cycles. So, right now, oil companies look particularly cheap. We do actually think they offer some good value. We are overweight energy in our client portfolios. It's worked very nicely for us so far this year, and hopefully it will continue to do so. We have trimmed a little bit, taken some profits there. But we think energy offers a lot, but don't expect oil to stay at $90 forever. We expect it to come back probably only in 3 years' time, but back down to, say, $60 or $70 a barrel. But overall, what you want to make sure is that you have an appropriately balanced portfolio with the right different businesses in it. Something like a Taiwan Semiconductor, very, very interesting business. They're the biggest maker of silicon chips in the world. Fantastic business, great returns on capital. All looks beautiful, the price looks great, and then you realize it's in Taiwan, and you listen to some of the comments out of the Chinese leadership about where they think Taiwan should be, and you realize that's why it's quite cheap. So, one must keep your eyes wide open and realize that predicting the future is a vague science at best. And if you appropriately diversify your portfolio, you can still get fantastic returns. But you don't want to think that you're too clever. That's how things can get a little bit dangerous.
Okay, so David, I'm going to take some of the questions coming through from the audience members right now, and to the point that you've just left us on about the appropriate diversification of the portfolio, because the question I'm going to take first relates to your slide on the correct blend between South Africa and global, the slide around correlation. And the question is coming from Sean. Hi, Sean. And the question is saying that correlations across assets change and look different over different periods of time. So how then do you use this or not looking forward?
Yeah, I suppose the first thing is, I can't explain an entire investment philosophy in a short session like this. But what we do is we are always assessing whether we think correlations are going to change or not. And the other thing to be careful of is that over short terms, correlations can be quite different. But over longer terms, you get a little bit more of a clearer idea. But yes, we're constantly assessing what may change. 2022, for example, fascinating year. First time you've ever had such a disaster across basically all asset classes. At one point, I think it was around about the end of September this year, global bonds were down 20% and global equities were down 20%. And normally those don't correlate. So you had quite a difficult situation. That was all in dollar terms. And yeah, you do need to make sure that you have the right set of assets. So if I just show this, I'm not sure if the slide is up, but the multi-strategy fund A, that is a global hedge fund that employs a variety of strategies that we utilize for our clients in the global balanced space. And that multi-strategy fund has a long history of basically zero correlation to anything else. And at times it does well, at times it maybe does a bit less well, but it's generally returns that you can trust. They normally try to get about sort of 6% per year in US dollar terms, employing a variety of sort of market neutral strategies. So you can look at that and sort of engage with the provider there and make sure that you understand their process. And, over a multi-year relationship with that external provider, you can make sure you've got exactly the right tool in your toolkit to do what you want it to do. And it's been particularly useful for us over the last few years, maybe before 2022, when global bonds haven't really delivered anything. And of course, this year, global bonds down a lot. That fund has only returned 2% in dollars this year, but compared to global bonds, who's kind of the other defense in your portfolio, that has really worked very well. So, global bonds down, I think now about 16% year to date. That fund up 1 or 2% in dollars year to date. It's really done its job.
Right. David, can you give us a bit of flavor of the constituents that are in this fund you were talking about that's done so well for you? Maybe not individual company names, but just a sectoral picture perhaps of where this fund is skewed more to and less away from?
Fifi, I won't tell you about that one because that's some quite complex market neutral strategies, as in long short things, trying to take advantage of weird sort of pools of liquidity in the markets. What I'll rather tell you about a little is our primary building block that we use for our clients in the offshore equity space. That building block has a sort of global high quality philosophy. So it invests in global businesses and particularly is focused on high quality. So that's high returns on equity, long life of business, long runway ahead, normally quite a good growth story up ahead, low debt, and just franchises that should be able to continue to grow for an extended period of time. Where they are currently invested, their philosophy means in that component, there's not financials, there's not energy. We compensate for that elsewhere to express our own views. But in that component, we've got a reasonable amount of tech. There's some China in there, which has actually bounced back very nicely over the last 6 weeks or so, mainly Chinese tech. They've got quite a lot of medical stuff. There's a little bit of tobacco in there. But the key thing that sort of pulls all of that together is that it's a high quality philosophy. So typically the businesses they own will be higher margin businesses, higher moats around their businesses. And that building block has certainly outperformed the market so far this year by about 6 or 7 percentage points. So we're quite happy there. And yeah, it's an interesting place to be. There's a lot of individual stocks that one can talk about. And certainly, one of the things they sold recently that had done fantastically well for them, something called Elevance. It used to be called Anthem. It's essentially a health insurance business in the United States that this time last year was looking terribly boring, and the market wasn't interested in boring this time last year. This time this year, the market loves boring because it's been a very difficult year, particularly for tech. So, that sort of boring business has heavily outperformed the rest of the market. But now the price is too high, so they've sold out of that just the other day and recycling that capital into more exciting opportunities.
Okay. David, I'm going to take another question from the audience, this one coming from Vincent Nwambis. And he's asking, is the volatility of illiquidity a problem? And which one of the two can you do with in the medium to long term?
Fifi, could you just repeat that question for me, please?
Yeah, no, it also didn't make 100% sense to me, but I'll give it another go. So essentially, is the volatility of illiquidity a problem? And if you had to choose between either one, which one would it be over the medium to long term?
I wonder if Vincent potentially means or. But so maybe just to talk a little bit about volatility, a little bit about illiquidity. Hopefully I can answer Vincent's question. Volatility in itself is not a problem. And often I get excited by volatility because that creates opportunities. Volatility typically will mean certain assets will trade above their fair values quite materially, and others will trade materially below their fair values. That's when I get excited. I can sell expensive things, recycle the money, buy cheap things, very happy. Illiquidity is a different story. If you're going to invest in illiquid assets, you need to probably be a reasonably sophisticated investor. Also make sure that it is a pretty small component of your portfolio because it is illiquid. So if something goes completely wrong and you suddenly need to access all of your savings, illiquid assets are illiquid, so you often can't access that money in an emergency. So be sure that you have enough money to solve your problems for the next 5 years if you're going to be locked into that investment for the next 5 years. Illiquid investments can make great investments. I think there's a definite scope for something like private equity in a portfolio for a high net worth individual. But illiquidity is a dangerous thing in itself. And if Vincent was asking about global illiquidity in terms of money supply, we're seeing the markets, with higher interest rates and the end of quantitative easing, and you're now getting quantitative tightening coming through, where governments or central banks are withdrawing liquidity from markets. That's part of the reason that markets are down this year. There's still ample liquidity out there. It's just not this absolute flood of liquidity that you had in the post-COVID period, where interest rates were exceptionally low, and the world was awash with money, and that's why we've had inflation this year, because there was kind of too much money chasing too few assets in the immediate post-COVID period. So I didn't understand the question perfectly. Hopefully that managed to answer some of it.
I think your explanation was crystal clear. And to Vincent, let us know what you think and whether that question was, in fact, your own, and the response is what you were looking for. So for those of you who haven't sent through your questions, please feel free to do so. You can do so by emailing events@moneyweb.coza or on the YouTube channel. And on the YouTube channel, you can send through your questions there via the chat box. And also feel free to share any key takeaways that you have with you right now on social media with us using the hashtag BetterInvestor, so we can see what it is that you are saying. So David, the other part of this conversation is investing for residency benefits. And I'd like to know what you think about that and how that will work.
Right. Fifi, it's an interesting one. If you're going to try to get residency somewhere else and invest for residency, I think it's very important to understand that the key role of that investment is not to make fantastic returns, but the role of that investment is to get you residency somewhere else. Some people may want to have an option to go be resident somewhere else in the world. And if you've got enough money, you can often buy that in different places in the world. Particularly, Portugal is a classic example. Costs you a few million rand worth of investment to go to Portugal, and you can, with time, get residency and citizenship there. But always understand that money that you invest to get your residency is not a great investment in all likelihood, except that it is the price of what you are buying in terms of residency. So don't try to make any investment do two jobs. An investment should always try to just do a single job, and that is make returns. If it's trying to do something else, don't expect it to make great returns for you. We can certainly help people out with that. We've got some options for our clients to help them to gain residency overseas and sort of at least point them in a direction where we think the investment at least is less likely to deliver terrible returns. But don't think your investing for residency is going to deliver great returns. It probably won't, because normally it's in the property space. And the country that you're going to is essentially has you a little bit over a barrel, so they can pick and choose where you're going to invest. And the other thing, always just something we haven't touched on, but something I would like to touch on, is just whenever you are investing offshore, just speak to your tax advisor before doing so, just to make sure that your tax situation is appropriate. If you have direct investments in the UK or the US, for example, There can be some problems around estate duty and things like that. If you die and your family is now left with that, there can be some quite heavy double taxation. For the details, speak to your tax advisor. We've got tax people that work in our business that can also help you out. But just be aware of the tax consequences before just dashing overseas and taking your money to invest there.
Okay, noted. So Vincent responded, and he did say that you answered the question appropriately, so spot on to you. David, if perhaps you can speak a little bit further about some of the risks that people may encounter if they are looking to take their money in other parts of the world for the purpose of gaining some form of residency there.
Well, I suppose the biggest risk is that often people who are looking to gain residency somewhere else, it can be quite emotional, and we're all human beings, and when we are a little bit more stressed about something and feeling a little bit more emotional, we can sometimes fall prey to bad actors, should we say. Not everybody out there is an absolute saint who has only your interests at heart. There can be folks out there who are looking to take advantage of people. So, what I would say is make sure that you do it through reputable agents who have been around for a long time, who understand these things, and who have seen the movie before. If you've got a partner to hold your hand for something like that, which can be quite expensive, if you're spending 7-8 million rand to try and get residency somewhere else, for everyone except a very, very small proportion of South Africans, that's a whole lot of money. And so you want to make sure you've got a partner that can help and guide you there, and is going to make sure that A, you don't get ripped off, and B, that the final investment is appropriate, C, that the tax is right, and D, that the fees aren't a nasty hidden cost. And that's why I say for things like that, get someone to hold your hand. And equally for any investing offshore, get someone to hold your hand. There are experts out there. Financial help nowadays is exceptionally cheap relative to most services in the economy. So you can really get a lot of help without it costing you a whole lot of money nowadays, in terms of getting your money offshore in the right amount, in what makes sense for you. Because remember, if you're investing for the next 30 years, or you're investing for the next 5 years, you're going to have a substantially different shape to your portfolio. And therefore, the amount of money that goes offshore for you would be a little bit different. The type of assets that goes into offshore for you would be different. So, that's why we have an advisor industry that can help you out. And, my business can certainly help you out, but there are, of course, others out there that also do a decent job.
Okay. So a few more questions coming through, and this one coming from Lizelle, asking about the opportunity cost of an investment that is purely for residency purposes. What do you think that is?
So this is, on average, please take these stats as a very rough guideline, but typically I would expect an investment in, say, global equities over a multi-year period to deliver you somewhere in the region of 8% per year in US dollars over an extended period of time. So that's kind of your baseline. And then if you compare that to what you can probably get on an after-fee basis for an investment where you're trying to gain residency, probably in something illiquid like property. So you would probably get, I would guess 1 to 2% per year in US dollar terms or euro terms out of that type of investment. But remember, you're being locked in. So typically, if you're going to be locked into an investment for 5 or 7 or 8 years, you would want a dollar return per year of north of 10%, probably more like 12%. So your opportunity cost, to answer the question, probably in the ballpark of 10% per year in US dollars would be my guess for your opportunity cost. But these are very, very broad thought processes here.
It sounds like you're saying that investing for residency purposes is a bad investment.
It depends what you want. Don't think of it as an investment. Think of it as that 10% it costs you per year. So let's say it costs you 7 million rand to get your residency. So it's going to cost you 700,000 rand a year for, say, 5 years. So work that out. Let's call it 3.5 million rand. That's essentially the price of gaining residency. And then you've got to weigh up whether you think that's worth it or not. And it's different for every person. And then, of course, there's lots of people that don't have the money in the first place, so it's a bit of a moot point. And, of course, people like myself who really like being in South Africa and are committed to staying here. So.
Yeah, myself included. David, let's circle back then to the ideal portfolio split and what it does look like between assets locally and assets offshore. You mentioned China, and you did mention that you like some companies there, some parts of that market. But I'd like your overall take on emerging markets and how that fits in your local offshore strategy.
Thank you, Fifi. That's actually something I forgot to mention earlier. Very, very important. Lovely question. Thank you. So when you think about, as a South African, taking some money offshore, and why do you do that? To diversify your portfolio is the key there. Typically, the South African markets, whether it's the debt market in terms of government debt or the equity markets in terms of the JSE, our markets will tend to move in line with other emerging markets. So what happens here will tend to largely be mirrored in places like Brazil or Indonesia or India or Mexico or Turkey. Largely, we'll kind of all move in a similar direction together. So if you're trying to get diversification, and it comes back, I'll just move the slides to this favorite picture of mine. It comes back to getting assets that have a low correlation to one another. So, the Brazilian market will actually have quite a high correlation to what happens in South Africa, and vice versa, because we're both kind of commodity-driven economies. We both have, should we say, imperfect governments, but across emerging markets, that's generally the situation. So really, as a South African, all of our research that we've done crunching the numbers shows that by taking money out of South Africa and simply putting it into an emerging market fund, you're not really getting much in terms of extra return. In fact, you basically get lower returns, and you're not getting much in terms of diversification. So if you, as a South African, want to get the best overall portfolio structure, I encourage you to rather have your global investments concentrated in developed markets, largely the States, Europe, Japan. The UK, I would include in Europe. Yes, the UK has had some wobbles lately, even to the point of being referred to as an emerging market. That's certainly not the case. But I would encourage South Africans looking for international diversification to make sure the vast majority of their non-SA assets are actually in developed markets overseas, because those are the ones where the correlation to our own market is the lowest, and that should give you the best long-term return coupled with the lowest volatility over extended periods of time. And then if I maybe just touch on China,
Sure.
Very, very difficult to understand what's going on there. Obviously, I mean, I've been to China a number of times over the years to look at investments there. I've been to Tencent's offices. That's Naspers' primary investment. And fascinating place, but it functions differently to what we know. And you have to understand that there, the government's set of priorities is often quite different to sort of how we might think about it. So always invest there with your eyes wide open and make sure that you don't allocate an inappropriate amount of your portfolio to Chinese assets. And I say inappropriate because everybody's appropriate allocation will be a little bit different. But don't try to get too bold with China. I think it's the world's second biggest economy. It's a growing economy. I would expect it over the next decade to grow faster than the rest of the world. And I think that a lot of Chinese companies are fantastic businesses. And if you're a business just looking after China, well, you've got 1.4 million customers, 1.4 billion customers that you can sell products to. So very interesting place. Just have one's eyes wide open. We have investments there. We think it's interesting. We would like to have more, but we just get a little bit nervous every now and then about our ability to predict the actions of the central government there.
Sure. So for viewers and listeners, including myself, who are interested in what you deem to be an appropriate amount of exposure to China right now, can you give us a bit of a color as to how much of your portfolio has got skin in that part of the world?
Right. So I suppose if I were to look on a look-through basis if I think purely equities, the equities, if we run a global equity solution for clients that has investments both in SA and internationally, in terms of actual Chinese businesses, it's probably around about 5 or 6% businesses that are listed in China. But then on a look-through basis, when you take into account where the companies make their money, it's probably getting sort of closer to 12 to 15%. But then remember, if you've got an iron ore company that's listed in South Africa or Australia, it makes its money from China, but it's not a Chinese business. But it is, in the end, dependent on what happens in that Chinese economy. And then just as a sort of indication, as I say, on a look-through basis, sort of low double digits in China, but then, more like 40 or thereabout percent in US listed businesses, which of course have fingers and pies all over the world. But China relatively small. Mm-hmm. I'd like it to be bigger because the price is beautiful.
Yeah, you just need a bit more predictability in the political office, and I'm not sure you're going to get that anytime soon. Until then, in terms of your asset choices, I mean, the very bulk of this conversation has been around your preference for equities, both here in South Africa as well as other parts of the world, most notably the US, and also bonds, mainly government bonds. But what about other asset classes as you think about offshore, even local right now? Things like cryptocurrency, things like commodities, for instance, maybe even a bit of cash. What's your take in how those asset classes fit into your strategy?
Right. Fifi, I think I'll keep the exciting one on cryptos for last. But firstly, if I just talk about cash, a well-diversified global portfolio should always have some cash, and normally you'd want it'd be sort of 4 or 5%, and normally you'd want that in US dollars as your sort of foundation point. And I think, given our view that we probably go into something of a recession next year in the States, in Europe, and possibly in much of the rest of the world as well. It's quite nice to have some dry powder. We might see asset prices get a bit more exciting. So I don't mind having some money in cash right now, not a lot, but having the optionality to deploy cash into a disaster, I think is quite exciting. You talk commodities, I'll just split that into two pieces of gold and then kind of industrial commodities. Gold, I think, given where inflation is, given where interest rates are, given the behavior of central bankers over the past number of years, I think it's useful to have just a little bit of gold, because gold is one of those things, again, so if you had gold on this page that I show with all my pretty colors, it would be green because it has a low correlation to other assets. All right. I don't show gold on this thing, But I think there's value in having just a few percent, probably 2-3% of a global multi-asset portfolio in gold, as a little bit of insurance against a potential recession next year, as well as insurance if all of these rate hikes aren't sustained and we get another bout of inflation, which isn't our base case, but it may yet happen. Their gold can do very nicely for you. And then other commodities, I am generally a little bit skeptical of holding direct commodities in the industrial space. So I wouldn't be buying or wouldn't be putting my money into like direct holdings in platinum or iron ore or oil or something like that. I'd much rather own businesses that are involved in those industries. So, a mining company or an oil company, I think there's a lot of value in that right now. As I mentioned earlier, we are overweight energy right now. We think energy looks quite interesting, particularly oil. Coal, I think, is a little bit more of a difficult one. One, I don't really like the ESG side of it. Two, the price of coal is ridiculously high at the moment, and I don't think it's sustainable. And then, mining company is, I think, a much better way to make money out of a commodity. Because if I just hold, 10 tons of iron ore in a warehouse somewhere, it doesn't do anything. If I own shares in a mining company, to use an example that most of the viewers will know, say something like an Anglo American, every day they go and add value by digging iron ore and various other minerals out of the ground and shipping it off to global markets. So they're creating value. Whereas if I hold iron ore, it does nothing for me. Over time, that Anglo-American business, you would expect to make profits, pay dividends, and actually deliver some sort of return. And I think that leads me in then to something like cryptocurrency. Cryptocurrency, just like my pile of iron ore in the imaginary warehouse, the cryptocurrency just sits there. It does nothing. It adds no value. In fact, we could debate for days around value that it attracts through energy usage and things. But really, your Bitcoin, to use that as the primary example, it just sits there. You can lend it out to somebody and maybe they'll pay you some interest on it, but all of that's a little bit artificial. If I own a share of a company, that is a contractual right to a slice of the profits of that business over time. That's what a share is. And it's the profits and the dividends that business pays. That's what you get. And you've got, in any business, a number of human beings and machines trying to actually add value. If you own shares in Toyota, for example, though, you've got a whole business worth of people trying to turn rubber and metal and leather and various other things into motor cars. They're adding value. They're creating value there. By contrast, a Bitcoin just sits there. It does nothing. It may have an investment case, and certainly, if you bought Bitcoin at $1,000 a Bitcoin and it's now worth 15,000, well, you've made great returns. But it's not something that I can justify putting client money into, because I just don't see any cash flows out of a Bitcoin. So for me, crypto is not the answer. I've studied this multiple times over the years, and every time I understand more, I learn more, I sort of get it a bit more, and I still can't see where are the cash flows. If I own a government bond, it's a contractual set of cash flows. So I can say, well, if I get 1,000 Rand at the end of the year, I'm willing to pay 900 Rand for it now. But if I'm going to get one Bitcoin in 10 years and one Bitcoin now, it doesn't make sense in terms of real investments that actually add value. That's my opinion. There are obviously many in the world.
For sure. You're sounding very much orthodox style, and there's nothing wrong with that, especially if it has worked for you from a portfolio management point of view. David, Thanks so much for joining us and sharing all your really useful insights and tips on navigating this really important investment topic of investing offshore and here in South Africa, and also the potential benefits or not in terms of residency. We'll leave it there and have a great afternoon further. And that brings my session to an end. Coming up next, Rake is joining you guys once again, and he'll be talking about whether you should invest through a trust, a company, or a derivative structure, and that conversation coming up in just a moment.